Maverick traders, welcome out to your currency midweek for October 5th. Corey here with you, and let's dive in and get to it. There's been a lot of things that have happened and transpired since we met 1 week ago. We always do these every Wednesday, and since last Wednesday, we've had the Bank of England with some major shifts, some policy changes in central banks. There's just plenty going on, so let's review. First and foremost, stocks are in a bear market, kind of a risk-off approach. However, last week I talked about this inverse cup and handle idea, basically that we're going to see a bullish correction, a bounce in the markets, a risk-on move. I talked about it a little bit more on Monday night when we did the RBA together, that I expected a rally, expected a bounce. We'll look at that chart here in a bit. Quantitative tightening has begun, the Fed shrinking their balance sheet, central banks raising rates, etc. However, major shifts took place the second half of last week. So US dollar reached kind of an exhaustion top, and part of the fuel for that was this change in policy. So the Bank of England basically initiated a new quantitative easing program, a new bond buying program, right? So they're going to start to buy bonds. The reason that they're buying those bonds is to basically stabilize the markets. We touched on this last week a little bit, that as rates go up, bond prices go down, and many institutions are actually leveraged to government bonds, and they lever them up because historically they're not that volatile, and because governments can print more money to pay off those bonds, etc. And so it's creating a lot of financial stress on these funds, and in some cases it's basically endowment funds and people's retirements and so forth. So anyway, they stepped in and said, hey, we're going to have massive failures in the financial worlds if we don't step in, and this is in the UK. Now, the US isn't in such kind of a dire situation, but certainly an issue. Over the weekend, a lot of rumors circulating that Credit Suisse and Deutsche Bank and some of these European banks are going to go under, and under massive amounts of stress and so forth. And so again, international markets, I would say the US is in a different place than the international markets. The international markets are experiencing a more severe level of stress. The US, it's not that we're, skating through perfectly, but we've got some advantages, and we just don't have the economic stress and maybe the stress on our banking system, the stress in our assets and so forth that Europe does, that the UK does. And so there's a little difference there where the international markets are making a shift. Make no mistake, they're going and saying, well, quantitative tightening, we need to pump the brakes on that a little bit. We can't let rates just keep exploding to the upside. We can't allow our economies to just collapse because we're trying to get a handle on inflation. That's not a good situation. And so you saw it on Monday night. We touched on this. I was a little bit surprised, but not a lot, that the RBA raised by less than the market had expected. And we talked about this before the announcement. I said, look, even if they do raise by this much, they're going to have a dovish commentary. We were looking at basically a long euro, short Aussie trade. Now, it spiked, and we really didn't have an opportunity to trade it. If you followed it over the next day or two, it went a couple hundred pips or whatever it was. But, the expectation for the Aussie to experience some downside and for them to turn dovish was really not even about how much they would raise rates by, but more about the fact that international markets are making a more dovish turn. They're saying, we can't allow our economies to collapse. And so that's the big story over the past week. And it has shifted markets. It's part of why the US dollar is topped out. Now, the Fed is going to be less likely to pivot as aggressively as international markets, but that doesn't mean that they're not going to pivot a little bit. Is the Fed going to keep with, hiking rates and super aggression? I think that even the Fed goes, hey, look, we might be creating a problem if we go too aggressive at this. Inflation is kind of tricky because remember, inflation is cumulative. So each month you report a CPI number, and then that gets added to the prior 11 months worth of inflation data to give you your annualized number. Well, for a while there, we were printing inflation at like 0.4, 0.5 monthly, and then you start doing the math on that, and you're like, well, 0.4 times 12, you're at 4.8. And then we had inflation coming in some months at 1% for the whole month. And you start printing 1% for the month across 12 months, well, you'd be at 12% annualized inflation and so forth. Well, the prior reading in CPI was 0.01. The next reading is expected to be around there. If you start doing the math and you say, well, if this is where inflation is at right now, the problem for the annualized number is we have some of those old numbers that are really high, right? We've got all these old numbers that aren't going to be gone for another number of months. So when you accumulate all these numbers, the annualized inflation is still really high. But if you say, well, recent inflation is at 0.1, and if we do that for 12 months, we only have 1.2 annualized inflation at a 0.01 monthly number, right? Now, I'm not saying that it's going to stay down here, but my point is that inflation's already been hit, okay? You're not seeing it in the annualized data, but you're seeing it in the monthly data. And this is something that I don't know. I'm just so perplexed by the Fed. I don't know what the Fed thinks, and I don't know if it's just because maybe it's kind of groupthink and they just don't, have the ability to kind of be different than each other. And so they all worry. I don't know what the process is there at the Fed, but man, they pretty much get everything wrong. Go back and look at their outlooks for the past year or two, their expectations, and they've just been completely wrong and backwards on everything. Everything they get wrong. So who thinks they're right about this? I don't. I kind of look at it as when inflation, when you are pumping out monthly numbers like this at the start, for them to say this is transitory and it's no big concern and so on is just stupid, because if you print a monthly number at 1% and the next month at 0.8 and the next month at 0.9 and so on, you're going to have a super high annualized inflation number that's going to freak people out and is going to freak you out over time as it keeps staying there. So for them to just keep saying it was transitory and so on was just idiotic, first of all. And then as you kind of look at now, we're printing 0.01 numbers and they're freaking out about inflation because the old numbers were at 1%. Well, okay, dummies, the old numbers were at 1%, but the new numbers are at 0.1. Which one do you care about more? Don't you care about what inflation is right now? And look, lumber's down by 60%. Base metals are down by over 50%. Corn and wheat, and I mean, it goes on and on down the list. These numbers are down by pretty extreme amounts. You're seeing huge deterioration in there's a buyer strike in real estate and so on and so forth. So, I mean, it just doesn't make sense to me. I just don't understand their thought process. Whatever they're using as far as their models and so on, they are completely upside down, just absolutely backwards. There's jokes that people make about Kramer on CNBC and basically doing the opposite of whatever he says. There's probably some truth to kind of whatever the Fed says right now, it's almost the opposite. It's mind-boggling. So, economic reports, you can see that in the US we had manufacturing PMI at 50.9. We had services a little better than expected, but that manufacturing number down there around 50, again, below 50 is more of a recessionary number, basically that we're not growing at all. So we're kind of on the cusp of, on the manufacturing side, of going into a recessionary type of number. RBNZ did raise as expected. They went from 3% to 3.5, but as we said, the RBA only went to 2.6 versus market's expectations that they were going to go to 2.85. So quarter of a percent less than markets were anticipating. As you look at the weekly performance, huge rally in risk assets. And again, I think this makes perfect sense. I talked last week about this inverse cup and handle. It's kind of playing out here. Look at oil up almost 10% on the week. Now, is oil, this is a number that matters to consumers, no doubt. Certainly, consumer confidence numbers are really linked to that oil number, but oil's come off significantly, and it's kind of the sticky area. There's just, frankly, not enough oil for the demand right now. 2020 caused massive disruptions. And then you've got Saudi Arabia and, the OPEC meetings where they're cutting production in an already tight market, which is kind of screwing over other countries and Europe and so on. And basically, I think OPEC is saying oil prices should be higher, but the U.S. is dumping oil from their strategic petroleum reserve and so on, and they're not happy that they're manipulating the price down. So OPEC is battling to manipulate the price back up, and it doesn't. It's almost again creating this problem where oil is, as far as energy, as far as like inflationary things, oil has held up so much better than everything else. Where you've seen lumber and all these other things collapse, oil never did that. It backed up. It certainly is way off of its highs, but nowhere near. I mean, when you're trading in the 80s and 90s, those oil companies are still printing money. Rest of the weekly performance we'll take a look at here in terms of those charts. So the S&P, as you kind of look at this chart, I hope I made mention of this. I usually do. Last week, hopefully, we kind of talked about that it's not uncommon to think of support and resistance. A lot of people think of it like it's a barrier, like it's a cement thing, really hard surface. I look at it as a mattress. I say, okay, here's the support zone, this key bottoming point for the S&P. What often happens is you squish into it. Almost think of it like a trampoline. A trampoline offers support, but when you land on it, it kind of squishes down and then springs you upward. This is very, very commonplace that you will pierce the prior low temporarily when it's such a key level. Markets do that because they want to, markets have a way of seeking out orders, right? And kind of inflicting pain and so on. So the reason that it will break temporarily, and it's not even really a break, it's kind of squishing into support and then springing the other way. It's a fake out move. It triggers a lot of stop losses. Think of all the selling pressure. All of this selling pressure. This is a lot of supply that was used up. Anyone that's willing to sell had an ample opportunity, right? They're selling, dumping shares. Well, where should it end? Should it just be picture perfect and land right on the support, or do you usually squish below and then spring up above? This is how, at critical key levels that everyone's watching, you'll see much more of this dynamic in place. A fake out move. If you're willing to sell, that forced you to do it. You capitulated. You gave up. You threw in the towel. You were probably holding out, that this level would hold. And when it didn't, you gave up hope. That's how markets operate. So, I like to trade those where it's kind of, if you see that squish in, but then it springs back the other way. Monday was really the telltale day. If Monday had come in weak and we sold off again, well, obviously you're breaking support, right? At that point, all bets are off. And if you tried to buy or anything, but I would prefer not guessing at it, but Monday is a great telltale sign that there's more to come. You recovered all of Friday's decline. You're back, above that level, reversal aggressively, and you just sold off so dramatically. I mean, this should have some upside, even though we're in a bear market type of thing. So here's your inverse cup and handle. Whoops, I didn't draw that very well. Here's your inverse cup and handle we talked about. and it should bounce up to around 38.50-ish is what it kind of prices out to. That is a handle that would be about 30% of the size of this cup. So, right up in there at about 38.50-ish in the S&P is probably the first target, the initial target. This week, all about risk on. So, as Friday's fake out, kind of a bear trap. Anyone that got super bearish on Friday, they got trapped and got their, leg caught in the trap, so to speak. Well, you can see the reversal. Kiwi, which has been the worst. This is often also how it happens where when you start to rally, sometimes the junk goes up the strongest, right? It's most heavily shorted, it springs back. Kiwi has just been trash. Well, it becomes a treasure. And then all these things that were defensive and were doing really well are now lagging and underperforming. As we look at crypto, a lot of people want to make it a lot of things. They want it to be an inflation hedge, they want it to be defensive. It's just not. It has never acted that way. It is a risk asset. It is heavily correlated to stocks and other things. When people want to take risk, they come into crypto. When the markets are crashing and people need liquidity, they sell crypto right along with everything else. So it has never been much of an inflation hedge or anything that way. So as we kind of look at the markets, the rest of this week, I mean, where do we go from here? If we look at crypto, it's kind of in a little bit of a bear flag. So I think it's kind of correcting similar to financial markets. Do we still end up at the end of the day moving to the downside? I think so. I think crypto probably does, right along with I would anticipate stocks probably do that as well. As we look at the rest of this week here, so couple of things to pay attention to, mainly happening on Friday. You've got Canadian employment and you've got non-farm payrolls in the US. So employment data out of both. What we'll be watching for is the reaction here could be backwards, meaning bad numbers, good stock reaction, good numbers, bad stock reaction. Meaning, if you kind of think of it in terms of what the Fed might do, if the numbers are really strong, then the Fed might feel like, hey, we've got a stronger economy and so on. What do we do about that? We might have a little bit more room to keep with our hawkishness. If the number's really bad and the employment picture starts to take a hit, they might say, hey, we need to stop being so aggressive, right? They've got two mandates, and employment is one of them, and inflation, price stability, is the other. So employment plays a role. Is it moving markets as much as CPI data, inflation data? No, but it's the next best thing. It's kind of the next telltale sign. So it could be one of those situations. If the number disappoints, that could actually be a situation where, sometimes strong numbers, you think, well, the economy's good. That might be bad for stocks because the Fed now can continue on its hawkish ways. If the number's weak, stocks might rally because they feel like the Fed will pivot more or at least slow things down. So good could be bad, bad could be good as far as that number is concerned. Now, let's take a look at a few different charts. If anyone has a request for something they want to look at specifically, fire away, and let's take a look here. I'm not sure where my screen went, but I wanted to talk a little bit about kind of the exhaustion high here in the US dollar. This is the daily chart, and you can see it just kind of was this exhaustive, reversal. Long upper shadow, big volume. Now, as we always say, when you get exhausted, what do? You often rest. So I don't know that the dollar's coming down a lot, but certainly looks more on the exhausted side. Kiwi's also kind of interesting in that it's the inverse. If you look at the Kiwi, it just was plummeting, 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 and then really had that kind of capitulation, that big expanded range, negative candle, kind of an exclamation point at the end of the sentence, and no surprise, it's bouncing. I think you could play Kiwi as kind of a buy the dip mode in the short term, because I would anticipate that even if the Kiwi isn't strong, that maybe we kind of Elliott wave this thing, make a little ABC, a little 1, 2, 3 style correction would be my thought. And the same process with USD. We've had the initial drop. As you rebound for a couple of days, it's probably a short, because ABC correction to the downside for USD. So that's my initial take, is I would be inclined to kind of counter trend trade. That's not normally what we do, but I think that's the market environment. Is we're playing a correction. We're playing a correction in the markets that's probably not going to last for very long, but should last for another week or so at least. And so in the short run, that's kind of where I'd be looking. We had a request for pound Kiwi. On the daily charts, you can pretty much see where the news hit, where things changed. And look at the reversal. Look at the plunge in the pound, and a lot of charts have this plunging in the pound when they reverse course. When they announced that change in policy, the pound initially got hammered, and since then, rocketing to the upside. So, huge reversal, and a lot of those pound pairs kind of have that sequence to it. It's going to be a hard one to kind of trade. I mean, you had that flush, and now it's this big bursting move. I think if you get a few days of selling, a few days of selling, then it would be more interesting as a buy. But I wouldn't chase it. I wouldn't be ready to just kind of pile in here. I'd wait for some give back, some pullback, something like that. But overall, I mean, this is how, exhaustion lows and huge reversal. We'll probably look back at this chart and say, okay, that was a pretty good bottoming point for the pound. So if you asked me where I think it's going overall, I mean, I would really back out this chart and show you the type of damage that's been done in the British pound versus so many other things. This has a lot of room that even if it's really pretty terrible, it can probably get up towards 160, a lot higher than here before it's all said and done, even though it's in this deep bear market. So, at least a temporary reversal, and in the short term, I think it probably should move a bit higher. But that's kind of it. Crypto's hard to trade. We just don't spend a lot of time on it right now, because what do you do with that chart? This is a daily chart. I mean, for the past few months, good luck with that. That's just incredibly difficult to trade. So I don't know what you do with that thing. I would kind of avoid. I am kind of open to almost any possibility. I think you kind of have to trust that with this market, there's a shift that's taken place. International markets moving a little bit more dovish, certainly halting some of the aggressiveness in which they're raising rates and such. So I would expect that, for the short term, some of these reversals are going to play out. But ultimately, let's not lose sight of the fact that this is still a bad market, a bearish market, and an inverse cup and handle ends up where? Well, most of the time, it ends up there, right? So, yes, you're getting this rally in the handle, like we had. This was our thesis. This was our, hypothesis, so to speak. Well, we're getting that result, but the next side of it is even more aggressive than this side. So it's been a nice, 6% rally so far, and probably has a couple more percent to go. But ultimately, you might see another 10, 15, 20% downside in equities. I don't think we're out of the woods yet. A lot of times when there's kind of this crisis of sorts, it gets ugly before it gets better. So that's the concern. All right. Well, we'll leave it there. Some major shifts, some major changes happening in the world of central banks. As I come back, let's take a look at the rest of the week. So we have a payroll preview coming out tomorrow. We will do our currency recap tomorrow, and then we will trade payrolls live at 8:15 a.m. Eastern Time. So come and join us. Make sure you register for that class, jump into it, and then, of course, we'll get out the trading room over the weekend. Have a great rest of your week. We will see you next week, same time, same place. Goodbye, everyone.